So, let's talk about intraday trading. You know, that fast-paced, high-stakes world of trying to buy and sell stocks all within a single day. The dream, of course, is to snag those quick profits from tiny little market moves. But wow, the reality can be absolutely brutal. So that brings us to the big question. Can a specific, data-driven strategy actually give you a real edge? Today, we are diving deep into one of the most popular signals out there, the moving average crossover.
Here's how we're going to break it all down. First, we'll get into the intraday trading puzzle itself. Then, we're going to decode what a crossover signal actually is. After that, we'll explore why it matters so much to traders, how a tool like ScanX can hunt them down, and finally, and this is super important, we're going to have a serious trader's reality check. Okay, let's get into it.
All right, first up, the intraday trading puzzle. See, before we can even begin to talk about solutions or strategies, we've got to understand the pressure cooker environment traders are in every single day, and the core challenge they're all trying to solve.
This is it. This is the fundamental question, right? The one every day trader asks themselves when they fire up their computer in the morning. It sounds so simple, but the market is, well, it's a complicated and pretty chaotic beast. So can it really be done day in and day out? The data, well, it paints a very, very stark picture.
That's not a typo. According to academic research, a staggering 80 to 85% of intraday traders are estimated to lose money. It is a tough, tough game. And it just makes you stop and wonder why. I mean, what is going so wrong for so many people? Well, it often boils down to good old human psychology. Things like a total absence of discipline, or just panicking the second the market gets a little choppy. Trying to fight the trend instead of just going with it. Not having a rock-solid limit on how much you're willing to lose. And oh, the classic mistake, revenge trading. Trying to aggressively win back money you just lost. These are exactly the kinds of traps a systematic strategy is supposed to help you avoid.
Which leads us perfectly into Section 2, decoding the crossover signal. How do we use data to find just a little bit of order in all of that market chaos? Okay, so at its heart, the concept is really simple. A moving average just smooths out price data over time. A crossover is just that moment when a shorter-term, faster-moving average crosses over a longer-term, slower one. And that event is what traders are watching for as a potential sign that the whole momentum of the market is about to shift.
Now, I love this analogy because it makes so much sense. Think of the short-term exponential moving average, the EMA, as your fast-moving scout. It's nimble. It reacts super quickly to whatever the price is doing right now. The long-term EMA, that's your battleship. It's slower, way more stable, and it represents the big underlying trend. A signal is what happens when that speedy little scout changes direction and zips across the path of the giant battleship. And here is exactly what that looks like in the wild, on a real chart. You can see these lines weaving around the price candles. See right there? When the fast line crosses above the slow line, that's a potential buy signal, or what traders call going long. And when it crosses below, that's your potential sell, or short, signal. It's just a really clear visual way to spot these shifts in momentum.
Okay, so we know what it is. Let's move on to Section 3 and build on this. Why does the signal even matter? What's the potential upside for a trader who is paying attention?
Well, there are a few really key potential benefits here. First, it could offer early detection of a new trend. It gives you a much more precise entry point, which takes a lot of the guesswork out of the timing. The crossover itself kind of acts as a validation, a confirmation that, market sentiment might actually be shifting. And finally, it gives you clear signals for getting in and getting out, which is just fundamental for any good risk management. Okay, so that's all the theory. But, knowing what a signal is and actually finding one in a market that's moving at 1,000,000 miles an hour, those are two totally different things. And that brings us to Section 4, where we're going to look at putting this into practice with a tool called ScanX.
I mean, this is the real-world hurdle, isn't it? There are thousands of stocks out there. You can't possibly sit and watch every single chart just waiting for two little lines to cross. It's an impossible amount of data for one person to track. And that's the exact problem that stock screeners or scanners were built to solve.
So this is the really clever part, how these tools actually work. A screener like ScanX uses a very specific two-step logic. Step 1 is find me all the stocks where the fast line is currently above the slow line. Okay, cool. But that trend could have started hours ago. So step 2 is where the magic comes in. It looks at the previous 15-minute candle and only shows you the stocks where the fast line was below the slow line just a moment ago.
And that's the whole point. This two-filter process doesn't just find stocks that are already in an uptrend.
No, it isolates the exact moment, the very candle, where the crossover just happened. It's designed specifically to find a fresh signal to give a trader a shot at getting in right at the very beginning of a potential new move. Now, this all sounds pretty amazing. Maybe almost a little too good to be true. And that's why it's time for our final, and honestly our most important section, the trader's reality check. This is all about separating the tool from the trader. Let's just be direct. Let's cut right to the chase. Does having a sophisticated scanner that finds these perfect textbook signals for you mean you are guaranteed to make money? As you've probably guessed, the answer is a big, firm no. And the reasons why are incredibly important to understand.
You don't have to take my word for it. We found this quote on a trading forum where people were discussing this exact tool, and it just captures the whole sentiment perfectly. A real user said, "It's a good start, but there's still a long way to go." That one sentence speaks volumes, doesn't it?
Because here's the fine print, the real-world limitations. A signal, no matter how great it looks, is just an alert. It is not a complete strategy. Then you have technical issues, like one user pointing out that their watch list on the tool was limited. And maybe most importantly, you have to remember, you are competing against thousands of other smart traders, and a lot of them are using the exact same signals, if not more advanced tools.
And that really brings us to our final thought here. A trader's true edge, it probably isn't found in one magic indicator or some secret scanner setting. The edge is found in the discipline to take a signal, like this moving average crossover, and build an entire robust strategy around it, with rules for managing your risk, for sizing your positions, and for knowing when the best trade is no trade at all. The tool can find the starting line, for sure, but the trader still has to run the race.